Welcome to another edition of Around the Table with Stacy Smith as we take a look at the economy and investing. The stock markets closed out the year on a strong note with the Dow setting a new all-time high. But the markets have stumbled so far out of the gates in 2024 with investors trying to balance their optimism with some of their fears. Part of that optimism, of course, is hopes that the economy is going to have a soft landing. But as stocks gyrate up and down, when should you consider making adjustments to your portfolio? That is going to be just part of the discussion we're going to have today on Around the Table with Stacy Smith. And here to discuss the topics and more is my panel of financial advisors and analysts. Let me introduce them to you now as we go around the table. First up is Carrie Coghill. Carrie is the president and CEO of Coghill Investment Strategies, headquartered here in Pittsburgh. Carrie has been recognized by Forbes as one of the top women advisors in the country. Also seated at the table is Frank Persetti. Frank is the managing director of HF Management Company, which is part of an alternative asset partnership. Now, Frank's background includes 50 years in the investing field, and he helped to establish Harvest Financial here in Pittsburgh, where he was the executive chairman. Across the table, we find Kim Forrest. Kim is the chief investment officer and the founder of Boca Capital Partners. Kim has a dual background in both finance and software engineering, and you may have seen Kim in her many appearances on CNBC, Fox Business, and also on Bloomberg. And there is one more seat at the table, and that is where we find Michael Godwin of Fregasso Advisors. Michael has a solid career in investing and is the chief investment officer for Fregasso Financial Advisors. And Fregasso Advisors is listed among the Barron's National Top 100 Independent Advisors. Thank you all for joining us once again for Around the Table. We're going to have a great year, we hope, here in 2024. And while the markets did surge ahead in the last quarter of 2023, as we discussed before, not all of the stocks took part in that rally. So, Carrie, I'm going to begin with you. How often and when should you consider making some changes to your investment holdings?
Well, looking at making changes in your portfolio is really an ongoing process because you need to understand what the various investment sectors are doing. If you own individual stocks, each company is part of a sector, and the changes in the economy overall will impact various sectors in different ways. So looking at the data, and I want to reiterate that, the data, not what CNBC is telling you or anyone else that can't back up what they're saying, but looking at the economic data and really trying to determine which sectors may or may not be influenced. A good example of this is that last year was we had the most predicted recession that never happened. And if you turned on the television in 2022, 2023, it was all about recession, recession, recession. But when you looked at the economic data, especially the employment numbers, we didn't see that. And to the best of my knowledge, we've never had a recession where the employment numbers were as strong as they were. So that really calls into question, do I need to be making a change to my portfolio? But aside from the data, the other issue that is very important is that if your goals change, you need to look at your portfolio to see if a change needs to be made.
I agree completely that any kind of portfolio needs, if not daily, at least some kind of periodic review. And what you're doing is seeing if the thesis of why you own whatever instrument it could be an ETF, it could be an individual stock, probably not a bond because it's way too expensive to trade bonds unless you think you're not going to get your principal back. But you should take a look at all of this. And I concur that especially at this time, when we're really finally leaving pandemicville, that you should make sure that some of the stocks that were doing well in the pandemic are no longer doing well and they kind of get the boot. Because the thesis of why you had those things was that people were going to stay inside, not go out or whatever the thesis is. Maybe it's drug companies. You really have to examine the reasons why you own them and make sure those things are still true.
Yeah, I agree with those as well. I mean, my job is to look at this stuff every day. So Stacy, your question was how often do you look at it? I look at it every day. Now, we certainly don't make adjustments or changes to portfolios and our client accounts on a daily basis. We try to have quite a longer term view in our theses, but it depends on what you're looking at as well. I mean, we'll make an adjustment to a stock position selling out of a stock that maybe has met our thesis and buying a new one far more often than we were going to make a change to our overall asset allocation strategy. Let me give you an example of that. About 4 years ago or so, we decreased our exposure to the international stock market and increased it to US. That's a long-term play of a 4 or 5 year period, where at some point we're going to look to take up our exposure to the international markets. But in between that time frame, we might sell out of one stock and buy another stock in that sector just because we think the relative valuations make a compelling case to do so. So it kind of depends on what you're looking at within your portfolios overall, I believe.
Let me ask you this question, Frank. I'm sorry. I just want to. You can take the answer if you make the answer if you want. But given what you've just said, let's take an example, and we're going to get into this a little bit more. But a stock such as Apple, which was downgraded and is now has tumbled. I think Michael, you said earlier it was like 6% down or something to that effect. Is that when you consider making a change in your portfolio at that point, reevaluating the tech sector, or when one particular major stock stumbles?
Years ago, Stacy, a mutual fund chairman was asked a question similar to that as to how he makes changes. Now, he had a portfolio of his mutual funds. And what he said is every January 1st, he sits down and he measures the performance of his funds. And he tends to, at that point in time, overweight the ones that did the worst and underweight the ones that did the best. And if you because the odds are they won't do it in the future because they just did it. The markets are anticipatory in nature. And if you look at what's going on now, we have a shortage of houses. So people are probably saying, I ought to buy home stocks. I mentioned this in our last meeting. And when you look at those stocks, they have already gone up dramatically. And so it's probably not time to be adding to those positions. However, there are things that are going to happen in the future, be it from infrastructure or wars or whatever, that are going to cause things to make sense. But you have to think about what's going to happen next, not what happened last.
Yeah, it's really like connecting the dots. I often refer to it as, those coloring books that we had when we were kids, that you had to connect the dots before you saw the picture. And that in our world, that's what it's like. Every day we're connecting the dots. As Michael said, it's not that we're making changes every day, but we need that information in order to have clarity about what the economy is doing in the markets.
Am I correct or incorrect on this, that it used to just be a philosophy that you would maybe take a look at your portfolio and make a change no more than twice a year? Can you make it more than that? Should you? Or is that, if you do it 3 or 4 times, is that too often?
When you hire people to manage your money, you're hiring strategies. They're making changes, as Mike says. He looks at it daily. And people who work for my former firm, with my former firm Harvest, we're looking at it daily. Kim looks at her portfolios daily. Carrie does the same thing. And you've hired people to do that. So what you need to do is look at your strategy from time to time, because you've set a target based on life expectancy, what you need to do, like educate, buy a house, whatever it is, retire, whatever your goals are. And then you need to address how you're attaining those goals and make adjustments accordingly. Those adjustments can change because of life events, economic events, market events. All sorts of things can create those change necessities. And that's the thing that I've always advised my clients to focus on: what's going on in their life, and make sure I know about it so that I can make adjustments if necessary.
All right, we have to take a break. We'll be back in just a moment. Welcome back to Around the Table with Stacy Smith as we take a look at the economy and investing. And we're kind of focusing right now on investing. And if you're considering to making some changes to your portfolio, Michael, how much does it matter, as I just mentioned a moment ago, that a stock has been downgraded, such as has been the case with Apple this past week?
Yeah, I'd say fortunately or unfortunately, Stacy, it does matter to a certain extent. And it's generally sell-side firms that issue price targets on a stock. So a sell-side firm is usually a bank such as JP Morgan, Goldman Sachs, Morgan Stanley, et cetera. And they have stock analysts there whose sole job is to research equities and understand all the ins and outs of how a particular company works. And then they put together a valuation or a particular price target on that stock. And these are called sell-side firms because they then essentially sell their research to investors who are going to buy and sell that stock that they cover. Now, because these sell-side analysts spend so much time analyzing the stocks that they cover, investors often do pay close attention to what an analyst either upgrades a stock or downgrades a stock. And most of the time, when you see an analyst upgrade a stock, you'll see the stock price jump a decent amount. And conversely, like we saw last week, when an analyst downgrades a stock, that stock usually suffers. As we're recording this, Apple got downgraded by a bank last week, and the stock is down about 5.5% to 6% or so this year. And so that's certainly worth paying attention to. The one interesting thing, Stacy, I'd like to point out is for how objective these analysts initially want to be or try to be. There's always some sort of bias or human element to them where they end up looking probably more favorably on a company that they cover or analyze. I think it's probably because they want to stay in the good graces of those companies. For example, when you're looking at Wall Street as a whole, the analysts there have a buy rating on about 60% of the stocks that they cover, and they only have a sell rating on about 5% of the stocks they cover. So they're really not out there telling their clients that they should sell the vast majority of stocks in their universe. But you can look at that and say, when an analyst actually does downgrade a stock, then maybe you really should kind of pay attention to why they are doing so.
Yeah, I want to pick up on what Michael was saying about, within these companies, there are conflicts of interest, right? If I'm an investment institution that has an investment banking branch, and I, have analysts and manage portfolios, well, what if I'm doing a deal, an investment banking deal with a publicly traded company? Am I really going to come out and put a sell rating on that company? And I know that there are,
Chinese firewalls.
Yeah, they're supposed to be separate, right? Compartmentalized. But I still really question the ability to remain biased with some of these analysts and with these very large firms and what they're dealing with.
Having been a sell-side analyst, I can tell you some of the obvious things. If I would spend, 6 months looking at a company and then come out with a sell on it, and that was my initial coverage, the company would never, ever talk to me again. That's just that. And who cares really? Because most of the stuff we do has to be publicly disclosed. But the real point of this is, where are you going with this? You're supposed to generate trades. That is what a sell-side analyst does, is you're saying to people, buy this. Hey, it's reached peak perfection. Hold it, which is a downgrade, which is a soft sell. Or if things are really terrible, they tell you to sell it. But these are trading vehicles, not buy and hold. And that's really where the thought has to go about whenever you see somebody come out with a buy, a sell, or a hold. And they used to have other names, but they don't do that. Accumulate, that was a good one. That meant, well, the price is too high, but on a good day, you should buy it. So the subtlety has been taken out. We got buy, sell, or hold. And, think long and hard about who's putting the buy on, or the change in, either buy, sell, or hold, and where they work and why they do it. And then look at why you want to own it. It's all about you. Why do you want to own it? What kind of return do you want? And I like longer time periods than a year. Most of the street is looking at year, what's the year going to end up? And they're going to try to make you trade as much as possible.
To just wrap that up very quickly, this conflict of interest situation is huge in the investment business. And now that I'm in just a piece of the investment business that does not deal in the public markets, I will say probably a little more bluntly than my other people can at this table, because they have relationships that they have to maintain, whereas I don't. And it is incredibly conflicted in the large firms. No one at this table has these problems, because we just advise you. we don't advise corporations that are public corporations on how they should do their investment banking, or whether they should take a loan or not, or whether they should take a loan for us. So we don't have these issues to deal with. As a matter of policy at Harvest, we had a policy that we only bought research from independent research analysts, people who had no underwriting, no investment banking, had no access to grind other than to give me what they actually believed. That didn't make them better. That just made them less conflicted. And we aren't getting, I'll never forget, probably the third day I was in this business, Penn Central went bankrupt. The day before they went bankrupt, Merrill Lynch issued a buy recommendation. Now, come on. I mean, they didn't go bankrupt because they didn't have debt. So somebody had an issue, and that was 50 some years ago. So
I don't want to take too much time on this because we're almost out of time on this segment. But from listening to the four of you, it's like, should I pay attention to any thing that I happen to read coming out from one of the big investment firms?
I mean, all those firms, it moves the market, right? I mean, we saw what happened to Apple last week. It got downgraded. And even on an upgrade, you'll see it move quite a bit. To Kim's point, though, the time frame that they're looking at is often in conflict the time frame you as an investor should be looking at. I mean, I think everybody at this table here is generally a longer term investor. That's been proven to probably be the best way for retail investors to grow their wealth over time. So you can't look at it on a quarter by quarter basis, but you behoove yourself to not really take what the analysts are saying into context when making your investment decisions. As Carrie mentioned, you're trying to connect pieces, and that's a pretty big piece when analyzing a company, in my opinion.
Right. Knowing why they downgraded or upgraded, what is the why? And then the question is, based on my knowledge, do I agree with it?
Yeah. Going back to the data. All right.
Yeah.
We need to take a break. We'll be back in just a moment. Welcome back to Around the Table with Stacy Smith as we take a look at the economy and investing. Now, most of us look forward to the holidays and spending time looking at the Christmas tree and exchanging gifts and everything. But one of our panelists here, Kim Forrest, I think gets more excited when the earnings season begins to hit. And one of them is about to begin. So, Kim, what are your expectations?
Well, as I alluded to on the lead-in or the advertisement for this show earlier this week, it's pre-announcement season. And what does that mean? Well, in the last week of the quarter and the first couple of weeks, generally companies are forced to tell you if their results materially differ from what they gave to investors at the beginning of the prior quarter. And looking at the pre-announcements, which have been light so far, I'm thinking that most companies have made at least, what they told the street. So they're within guidelines, we'll put it that way. That bit of data, as well as some other data, the jobs data looked okay. I wasn't going to say it was the super strongest ever or anything like that, but it was good enough. And also looking at other indicators, it looks like we had an okay holiday season with respect to consumer spending. So I'm thinking, we're going to have a pretty good earnings season. Now, the biggest thing that I get out of earnings season, which brings me the most joy, although not quite as much as opening gifts on Christmas, but close, is what the companies are going to say about the next 6 months. That is what I'm listening to each and every call that I listen to, and I rush to the guidance part of the earnings release. Now, you too can look at these. If you go to a service like Yahoo, which is free, Yahoo Finance, and you type in your ticker symbol on the day of the earnings release and you read the earnings release, look at guidance. That says, are things getting better or are they getting worse? So this is why I'm so ramped up about earnings season.
When you look at that guidance, understand that is engineered by communications specialists. These people are very good at guiding you to just a little worse than it probably is going to be. So I honestly believe that the reason most corporations beat expectation is because they engineer expectations to be a little worse than what they believe will actually happen. And when the market trashes a stock, it's because they failed at that and they did worse than
So,
than the bad they tried to tell you they were going to do.
so I love that point. And I would actually, sorry to take over, Stacy. I would actually ask him, when a company does that, right? Do they risk developing a bad relationship with analysts? And how does that work?
Oh yeah, they so do. Well, everybody in the industry knows this is kind of like a dating app. Very best picture ever. Very good behavior. Like this is the first date all the time. They are on best behavior whenever they're talking to analysts. And again, you're right. They're guiding, so that they can step over the success line. And if they don't, things go sour because, the sell side analysts have to write stuff. They have to develop models. And if they're given terrible information from the company itself, just like if, somebody shows up late for that first date, you get a demerit, right? So, human nature is wrapped all around this. So good question, Carrie.
I was always
Yeah.
curious about that.
But in the
Stacy-
end, it's the numbers that matter and the earnings that end up mattering, over time, because stocks follow earnings over time. That's undeniable for the most part. And if I look at last year, I think earnings, Kim might be able to tell better than I, but I think earnings for the S&P 500 were pretty flat last year. I mean, they were up a great deal for that Magnificent Seven stocks that we've discussed ad nauseum in the past, but for the rest of the S&P 500, I think earnings were pretty close to being essentially flat on the year. And as we look into this year, 2024, I mean, if I had to, being a prognosticator, I would expect this to be a year of slowing economic growth, single-digit earnings expectations growth there, and probably single-digit returns on the average stock.
It really depends on what they're doing, right? Because if they have commodity inputs and commodity prices are falling, which I see that they are, it could be a pretty good year for those companies. So and if my favorite are software companies, although oddly enough, I don't hold many right now. That's just what's happening in the world. But anyhow, people costs are another one. And again, those are ameliorating. Sorry for the big word, but that's what they are. They're softening. They are not going down to zero or negative. They're not paying people less this year, but things are really kind of softening in inflation. So I'm going to push back at that and say we could have a better than just maybe high single digit kind of year.
And add to this that 40% of the corporate earnings are international. And if interest rates go down anywhere near as much as some are predicting, the dollar will get weak, which means the U.S. corporations from their foreign sales will get more dollars, which will show bigger earnings, even though it's just math.
Yeah, they're supposed to take those out in constant currency, but I get you, Frank. You're right.
Yeah, but what's that mean?
All right, we have to take a break. We'll be back in just a moment. Welcome back to Around the Table with Stacy Smith as we take a look at investing in the economy. At the end of the year, investors were very optimistic. A very big present was waiting for them under the Christmas tree, and that was that the Fed would begin lowering interest rates sooner rather than later, and that it would lead to a soft landing for the economy. So, Frank, how important is a soft landing for the economy?
Well, a soft landing means that in this case, in your question's case, the Fed has engineered a reduction of inflation without having a recession. All right. And right now, it looks like that is what's happening. That being said, the question becomes, are they going to drop interest rates in March and May and June, whenever? And it'll be a raging debate right up until they talk. And the odds makers on Wall Street will have percentage this is going to happen and percentage that's going to happen. And I find it all very interesting and comical because nobody really knows what the Fed's going to do, including the Fed. And they're going to take the data and they're going to make their decision as the data comes out. And right now they're paying attention to payroll. And the payroll is a big deal. And if the payroll numbers are doing what they seem to be doing, which is we're growing employees, we're not growing wages at excess of inflation. We've kind of kept pace with inflation almost. And all these things are good for the future. And if it keeps going like that, then I can see that the Fed might at some point drop rates a little bit. But their fear is if they drop it too much, they'll get the inflation all fired up again. They'll get whipsawed and they'll have to raise them again quickly. Which if the soft landing fails and we have a recession, look for interest rates to go down a lot. And the reason is that's the only weapon the Fed really has anymore: print money and lower interest rates and just make money flow faster. And right now, printing money is going to be a little hard to do. They've printed so much of it; it's going to be a little difficult to use that tool these days. So it's very important that a soft landing or no landing happens. And the debate, we'll see. But when it comes right back to it, it comes back to what we were talking about earlier. Long term, now not July or the next 12 months even, but over the next few years, which most people should be paying attention to, it's going to come down to the earnings.
I think it's so funny that, not really funny, but that people are like cheering for all these interest rate declines this year. And what I say is, do you know what that means? Do you know what would have to happen for 5, 6 interest rate declines to happen? Be careful what you wish for.
Yeah, it depends on, again, we talked about this before, why they're cutting those rates, right? I mean, if they're cutting it because inflation, to Frank's point, really is at that 2% and economic growth is sort of middling, they'll cut them and hopefully you don't have a problem. My biggest worry is there's just too much good news baked into stock prices, right? The market's already expecting that soft landing that Frank was talking about. As Carrie just pointed out, the market's forecasting 5 to 6 rate cuts already this year. If those don't materialize, I'm a little bit worried about what we could see happening in the markets.
Who really wants the 5 or 6 rate cuts? Who does it benefit the most?
I mean, it does benefit companies, right? Because, I mean, a lot of companies termed out their debt, meaning they borrowed a lot of money when rates are low and they extended their maturities, but they're going to have debt that comes due, and with lower interest rates, they'll be able to lock in lower rates. Not akin to what happens to people when they want to go out and get a mortgage. Rates might come back down, and you can now afford a more expensive house if mortgage rates come back down quite a bit. But to Carrie's point, cutting rates a bit could just, and Frank's point, just reignite the inflation cycle that we've come to see over the past couple of years.
Right now, rates aren't that high. They're kind of normal. The short rates are high, but the long rates are actually low. The yield curve is inverted right now, and that is a sign of a recession. They say what the government could do, if they could do. I don't know if they could do this. If I were running the Fed, I would be borrowing money for 30 years at 4% and 3.5%. I wouldn't be doing overnight rates at 5. Why do that? Let's lock it in and fix that thing, and then work on buying back debt when interest rates do go up, and you can buy these things cheaper. And if you have a surplus, which I guess that's not realistic. But
Kim, why don't you wrap it up for us? We're almost out of time. Go ahead.
Thanks. Well, I'm going to be a contrarian here and say I almost don't care what the Fed does because the bond people have taken control. Like anytime the 10-year goes under 4%, market seems to go up. And I think that's really what is going to drive the very short term here is if the bond people think that some amount, we don't know if it's 6, we don't know if it's 2, but that there would be some kind of softening in the Fed's view of the world, and that there even might be a rate cut. It seems that those longer term bonds, and if I think the 10-year for investors or even businesses trying to figure out if they should deploy capital, that's what we all use as the discount rate. So what the 10-year does is the most important thing. And it's based on what the Fed is thinking, but not so much their actions. So let's see how 2024 turns out.
Indeed, we'll have to wait and see. I want to thank all of you for joining us once again for Around the Table with Stacy Smith. A special thanks to Frank and Michael and Kim and Carrie. And we hope to see you the next time for Around the Table with Stacy Smith. Thanks for joining us.